You don't have to stay in as long as it's not working. Testing, testing. I think it's getting connected. Here we go. Can you guys see my screen? You can see it? Okay, sweet. All right. Man, I apologize to everyone for the difficulty. Facebook, they're really good at changing settings and not letting you know. So, long story short, what worked literally just like 48 hours ago didn't, and I had to reset my re-download a Chrome browser, beta, etc. Blah blah blah. Anyway, we're up and live. So today is a unique one. We're going to mix it up a little bit. We've kind of gone over this basic PowerPoint every time, which is great, but you can also go back last month and check it out. It really kind of covers more of the basics. What is a note? How does it work? Etc. Blah, blah, blah. So that's a very basic passive level of doing it. Today I'm going to show you how we can create notes. Like, where do the notes come from, right? Well, this is a strategy of acquiring rental property via seller financing. And in my opinion, it's pretty incredible what you can do with it on the backside. So, can you see the title in there? Does it show? The title of the video is going to show this. I have probably two that we'll do today, especially because we're running late. But basically, this is a case study that I'm working on setting a closing date for May 31st, 2 weeks, of acquiring a rental property via seller financing and creating $100,000 of equity in 12 years and cash flowing $500 a month, adding $72,000 in gross profit the whole way. Is that conceivable and doable? Yes. And we're about to find out because it probably sounds too good to be true, but I'll tell you exactly how it's working and exactly how it's going to work. So anyway, I'm going to show you, I have the properties up over here as well, so bear with me, I'm switching between two screens, but this is an active deal that I have working, so I'm going to pull it up so you guys can see it. Feel free to read through that at the same time, but I have a full-time leads manager, and she is where this originated from. Just I kind of want to show you guys the what do you will, the evolution of it all. It starts at the beginning. So she got in contact via one of our marketing strategies, and what we offer, there's 1,000 people out there that are, okay, we'll throw you a cash offer, take it or leave it, we can close in 3 to 5 days. Well, basically what I do is like, hey, I'm an a la carte. We can help you 1,000 different ways. How do you want help? The rental side, do you like the cash flow? Do you want to just cash out? But it's a way to strategize, hey, I can pay you a lot higher price if you're willing to work with me on this, but then also structure the financing where it's super advantageous. So give me a second to log in. Again, I had all this up and at 'em, but Facebook made me redo it. Alright, hang on. Here it is. Alright. So, here's the screenshot while it loads. I wish I could get a better picture, but I really can't. You can go look at it on Google Maps. Not going to put the address out there, obviously, but here we go. There's that right here, just to get a little idea of what things look like right now. All right. Thank you for bearing with me. So here's the property. We structured, they had it for sale. They have a few rental properties. I want to build good credibility, etc. They said that they wanted $90,000 firm. So I looked at the deal, and it's in pretty good shape. I mean, you can see it's a 3.2. That's good as well. It's got central AC. That's not very old. Been rebuilt. Again, it's your typical rental, though, so it's not like top of the line. You can see this estimate range is somewhat reasonable. They're buying houses now, so they got a lot more accurate. But long story short, just to get you an idea, their estimate range is 75 to 120. I offered him, I think, like 60 cash, and it's like, hey, man, in order to make a profit, like, and flip it. This is how I'd have to do. But one of the things I try to tell them when they're like, that price didn't work is, okay, well, what are you looking to do? And so it's a guy, he's a teacher, he's helping his dad sell the property. And he's like, he really wants to get the cash and move out to the country and do some bill stuff. And I was like, okay, so how does he actually need all the cash, or does he just need a little bit? He's like, I don't know, probably 20% or something. So he threw out 20%. It's like, okay, that's a tick point. That's a trigger point. Is a better word. So tried to structure that in there. I basically had to work backwards because it's like I don't want to get a rental property that I'm not cash flowing $500 a month. That's just kind of my thing. It's not worth my time if it's not doing that. But then you combine the seller financing in there with it, and I personally, no offense, will not be purchasing through a bank again in terms of rental property. And the next case study, which I'll probably get to today and just do two of them, but that's a perfect case scenario of how I couldn't make a financial situation make sense, but we're going to work a seller finance deal to where it does make a lot more sense. So anyway, continuing on, big lot, and I've seen it. Obviously, there's not a whole lot that you can see right there in terms of the product, but it's okay. It's just your typical, what are you going to get for less than $100,000 property? Currently renting out at $950. So, kind of working backwards. It could probably under rented because they've been there a while. But $950 minus $500 leaves us $450. So $450 is what I had to play with. And let me I guess I'll type out these numbers. Now I'm telling you a little bit of my thought process and rationale went into this. So here's all the information. They want 90 grand, would do 20%. So if I can give them 90 grand and 20% and make it happen, let's do it. They're renting out 950, so I based it off that. Now, $500 a month is what I want, so we're at 950 minus 500 monthly profit. Okay. Rent minus. Anyway, so you guys can go back and look at this and do it. So 950, that equals 450 gross. So insurance on this place is on the tax records, I think, for, I don't know, can't remember. We'll even just say 90. $90,000 times 0.022, which is high. That would be that. So divided by 12. Taxes are $165 a month. Okay, and insurance minus. Somebody would easily insure that for $100 a month. Probably getting less than that. So 165, and then insurance. Okay, so that leaves us with net profit before other stuff. I'll go down to the next page. All right, so 950 minus 500 minus 165 minus 100. I didn't do that right. Oh, I guess I did. All right, that leaves us with 185 to play with. So, what does this number mean? Payment, ideal payment. That's the best way to put it. So this is the ideal payment of what I want to be paying the seller in order for me to comfortably cash flow $500 a month. Now, I know this is low, and I can probably get that lower. That's high. So my point is, I got room in here, but it's better to err off the side of conservatism. Okay. So again, working backwards. Let's go back. They wanted 90,000, and they were content with 20%. It's renting at 950. So going over here, 950. I want to make $500. That's the gross payment. And then minus taxes and insurance, my ideal payment to the seller is give them 20% at closing, which is $18,000. And here's the offer right here. So $90,000 is what we agreed to. 20% down is what we agreed to. That's $18,000. I'm paying closing costs as well. So that's another, $2 grand or so. So $20,000 out of pocket. Okay. So I structured backwards. I got on my financial calculator, which we're gonna do it. We'll look at it. It's gonna confuse you, some of you, but it's still good to see, and you can go back and look at this. Let's see. This won't confuse you too much. All right. So I don't like that one. Let's use an easier one. Come on. Man, I have an app for this that it's just amazing. Shoot. Guess I can use that other one if it's... Alright, whatever. We're gonna do it. Alright, number of periods. Actually, I'm sorry, this would be better. Because then I can show you the different exit strategies on the backside. Thank you for bearing with me. But anyway, this is just a rental situation. There are definitely numerous strategies on the backside, but I'll probably cover those next month. All right, anyway, so we finance, again, going back to it, I offered them the 20% down, so $18,000 at closing, $20,000. So that's what I'm going to have into it. We have a 12-year term. Now, here's a very interesting part that I don't know if anybody's picked up on yet, but if you have, you're pretty savvy. I ran these figures at 0% interest. So they're amortizing this 12-year loan at 0% interest. How amortization works, let me show you. Most of you know that, but side by side. So my loan amount, $90,000 minus 8, it'll be $72,000. That's what I still owe them. And just to show them basic term, because I'm having a balloon at the end, but I'm just going to show the term. So here's a 0% if it paid off the whole time, and then here is a exact same loan, same term, same everything, even simply at 3%. It basically is an extra $13,824 over the same time. So it's saving me $14,000, which, you know, is a lot of money. It just amortizes that way. So obviously the next case study is a lot higher playing field, a $475,000 sales price that we're going to go over. But again, just to show you over time, I wanted you to see that. Alrighty, so I worked the payment with him. At the 0% is $277.78 a month, and that's basically working it that way. And then I will owe him, let's see here, 144 times 277.78 is those are all the payments that I'll be paying into him. So how I did it was to structure, give him, you know, almost two liens, if you will. It's let me show you here. So structured at 12 years, $40,000 at 0% leads me to this right here, 277. Okay, so the lump sum at the end, which I owe right here, the 32,000. That will be paid, and I'll either have to refinance or something, but we'll get to that in just a second. But the point is, we're paying this $40,000 loan off at 0% because his trigger point was 20% down. He's way more interested in this, so I can work favorable 0% interest. But I didn't even submit it. I literally submitted exactly what you saw at the beginning, and it was I just sent him the payment number and for the amount of years with that due at the end. So I said, hey, you want your money today, you want your money tomorrow, and you want your money in the future? This is your option. And I put that in the email. So let's go back to this over here. You know, how do you acquire this, create $100,000 in equity, and then, you know, gross profit that the whole way? Well, it's really simple. So I'm showing you how the liens are split up and whatnot, how I did it. And then $500 a month is my cash flow, which again, we worked backwards from the rent and the payments to show you exactly how to get that $500 a month. We build it in there. So again, I do need to say that I'm a $90 over what my ideal payment is, but again, I was high here, so and again, if I end up making $400 a month, okay, that's fine. Especially if I'm 12 years, I'm guaranteed $100,000 in equity. That will pay for a lot of tuition. That'll pay for a car. You know what I'm saying? A lot of stuff. And keep in mind, it's costing me $18,000 out of pocket, more like 20. Today to basically turn it into, $172,000 if this gross, if this went as planned. Which again, I'll need to do some expenses along the way, and whatnot. But my point is, so 500 times 144, 12 years, that's $72,000. Okay, I factored in 2% increase per year for the $100,000 sales price. I feel like that thing easily, with the right amount of work, would sell for $100,000 easily. I think the house is like 1,200 square feet or something too. So there's a lot of room to increase the rent as well, and tons of different strategies you can do. But let's see here. Here's the summary. I know I'm kind of all over the place, but again, didn't expect the technical difficulties. But with the 2% increase per year, 1.02 times 100,000, do that 12 times, get you right about 130,000. Well, in 12 years, I'm going to owe $32,000 because this whole amount is paid off, and I gave him that amount at closing. So I will have given him $58,000, and I owe him the remaining $32,000 of that original $90,000 we agreed upon. 12 years in the future, I probably have like 10 kids, and no. But anyway, the point is, it's just a very interesting way to piece it backwards, and get the exact profit and what you want, a lot better than kind of going through a bank. And if I had to put 20% down there, they would amortize like 20 years, 30 years with a balloon, which is not bad. This is just better. And I think everyone agree that $100,000 in equity, you can do a lot with that line of credit. Speaking of which, if any of you have home equity lines of credit that you qualify for and you want to put that money to work, this is an excellent strategy. I can structure these deals all day long, and I personally am acquiring, this one for myself, and there's, 2 others that I'm actually trying to figure out the closing date on. We've basically agreed to terms like these. But please tell me how else you can find $172,000 again. And if I'm wrong by, let's say $172,000 gross profit, right? If I'm wrong by 20%, or heck, even 30%, so 70% of that value is $120,000 still. So that's a lot of money that, I'm going to have a property manager managing this and just kind of out of sight, out of mind, hopefully and ideally. But at the end of the day, at any time, I can just rehab it, flip it, and then, get all that money back. I guess I'll do it. There's another, strategy. I won't get too detailed into that. I'll do this more next month, but I guess I'll dangle the carrot a little bit. If I'm getting 0% financing here on $72,000, again, there's a balloon, so we're just going to keep it simple. $72,000 there. Sorry, got a text message. But anyway, $72,000, 0% interest here, and then let's say, even if let's do 0%. So let's say I sell or finance this to an investor and tried to recuperate my 20% down and got a literal lump sum, 18 grand. So now I'm out of pocket nothing. And I have a 0% thing, so I'm making my $277 a month payment here. But I don't know if this is called RAP sub 2, I can't remember, and that's why attorneys exist, so I don't have to worry about this crap. But $72,000, if I can sell it to an investor at, let's just say, let's do 9% and we'll work backwards. 9%, which is realistic because they can refinance, but let's just say, we'll say 8%. That monthly payment here, just simply again, is a lot different. It's $279 a month difference. Now, Again, I want you to remember I got my 20%. This loan 2 is another investor. So I'm investor loan 1 paying the original seller. And I know this is confusing. There's seller 1 here. We agreed to this right here. Okay? And so I'm paying them that. Now loan 2 is an agreement between me and another investor. Same term, same everything. And you can structure these things way different too. But cash flowing, I can cash flow per month, the same term if he wrote it out, $279, but I literally will never have to make a repair. I'll never have to pay a property tax, and I will have a first lien position. So again, go back and watch the other video if you want to understand what I'm saying or don't, and then you'll understand what first lien positions are, etc., stuff like that. Well, I say first lien position. I guess the other guy would have one. But anyway, they will sign a subordination clause, meaning, so that's what it would be, a sub 2 loan here. But long story short, look at how that amortizes. So again, if I have, anytime they were to sell or refinance it, I have a hard time seeing it. So, thank you. My tech team, aka my wife, said to make it bigger. Oh, really? Sorry about that, everybody. You can blow it up on your screen too, it'd be probably a little bit fuzzier, but. Alright, sorry about that, but long story short, you can see how a 9% interest pays off a lot slower than 0% interest, and you maintain like a $5,000 to $10,000 spread. So at any time, I'm cash flowing that whole amount, and I'm not cash flowing as much doing $279, but I'm also not having to worry about property taxes, repairs, and etc. That's what the banks do. And when I'm telling you what they do, wrapping these loans and whatnot, you better believe that they do the same thing. They get lines of credit, mortgages, etc. They wrap these loans to other banks who are looking to acquire. They 100% do this. Any of you who bought a new build home from DHI Mortgage, I'm pretty sure they sell like 100% unless something's changed of their mortgages. You get something in the mail within 3 months. They're doing the exact same thing. They're marking it up. They're charging fees, doing stuff like that. So this is very, very high level stuff. And again, it's a lot better than this and whatnot, but I just have to show you because I'm limited due to the software engineering that I don't know how to do. But it's a very interesting way to, instead of getting rent, you're arbitraging your interest rates and your payments and getting the rent on the money, if you will. So wanted to kind of show you that as another potential strategy. But in its most basic form, I like the thought of getting $100,000 in equity, not guaranteed, but even if I'm wrong, there's a ton of room for improvement. There's a $100,000 spread in our valuations that we're trying to predict in the future. And I think I'm actually being pretty dang conservative at 2% there. You see what I'm saying? So in 12 years, think about 12 years ago. It was 2008, ironically. Very ironically. So, you know, think about if you would have bought something then at these dirt cheap prices, they appreciate. I mean, there's some properties. I'm selling a friend's house now that is appreciated $100,000 from like 250 or 260 to. They think it's worth substantially more. But anyway, that's a goal. That's the case study. This is just an extremely creative way to do it. I can structure these deals. I have a ton negotiating. I do the same old, you know, wholesaling, etc. But there's some people who want all their cash today and need all their cash today. Then there's other people who, there's another one. I'm not going to show you that case study because it's really similar to this one. But her son and I are speaking next Monday. They like the terms. They said they're in agreement. They just really want to, you know, officially process. But I also sent them, like, I said $60,000, $61,000 today. Or if you let me pay you 10% today, I'll pay you $65,000 total if you let me flip it in 9 months. But she told me something on the phone that was like, you know, I really like the rent. I liked having that because it helped out with bills. I said, so you like the rent, but you hated dealing with the tenants and the repairs and tax. She goes, yeah, 100%. I said, I have the perfect option for you. I said, we'll figure it out, and I'm going to try to structure that. See that 20% down? I'm trying to structure that 0% down. I'd be very happy to pay 3-4% interest with 0% down, and then seller finance, wrap it on the back, sub 2 on the back side. Get their 20% down, but charge them 9% interest, 8% interest, then I'm making 5 to 6% a month. But if I put 0% down and I get 20% down, I get $18,000 in my pocket today. Does that make sense? I hope it does. And you're probably going to want to go over this a few times, look back on it, etc. But long story short, this is 100% what I'm putting all resources into. And I bought rental property through a bank a couple times, and I'm not going to do it again. So I bought my own house. This is even an interesting way to structure personal home, and to be honest with you, it's more than likely what I will end up doing on the next home. But that is one case study. I'm going to show you a little bit different one, kind of similar, but different. Give me 1 second. This is a lot different price range. So I don't even remember what the numbers are off the top of my head, so we'll figure it out at the end. But I think you guys are going to love this. Here's my strategy, and I'll kind of tell you what my thought process was. And this is a super, super sweet lady. We've gotten along. We've gone to eat a couple times, and she has 12 rental properties, owns 11 of them outright. This is the only one that has a mortgage, so it makes it a little bit messy. But again, we can figure it out. So here's how I can give her a very unrealistic sales price and make it worth my while and make it worth her while and make it actually extremely advantageous and significantly over the pay for the property, if you will. She's kind of wanting the price where here's how it works. It's rented out. It's a duplex. It's a really nice duplex, and each side is rented out. One tenant's been in there for a few months, and the other tenant's been in there for 10 years. Both of them are paying $16.50. It's under-rented, so that's a good thing, but all I can do if they want to keep the tenants in there, and that's something I will make a contingent on and honor my word, as long as they're, being good tenants. But, hey, if you want me to keep them in there, this is how it works. So I'm going to show you the property. Right here. Oops. Alright, here's the property. Take a look, take a gander. It's at $370 on Zestimate. It's a super nice duplex. You can see those two doors. Brand new roof, brand new ACs, updated. It's not like Chip and Joanna, but it's very nice. Updated tile, updated countertops. I think they're like 2.5s also. So look at that rent estimate, $2,000 a month. So again, $16.50, kind of low. But just kind of, again, working backwards and got to err on the side of conservatism. Let's see here. Let me blow this up a little bit more. And I'm going to kind of send over our back and forth of what she wanted. How I said it doesn't work for me to do that, but I want to make a deal. Here we go. All right. So trigger points, not wanting to deal with it anymore. One of hers is a down payment, but I basically said, hey, if I'm paying over this price, I want my down payment to be as small as possible. And I know she'll work with me on rate and whatnot, because especially I'm going to do like a shorter term with a balloon. So she wants here we go. Struggles. Let's see, we're about 30 minutes. Okay, this is the last one. I'll get over it a little bit quicker, try to, but she goes, hey, I know she was in the mortgage banking business for a while, did very, very well, super savvy, and that's why this works, because she understands numbers. Says, hey, I got a friend that's still in it. You can put down 20%, get you 5.5% rate, $475. So I said, okay, based on what you want, I can't do that. And it said if I were to put down 20%, it's $95,000. Not a wise use of capital. Another struggle is, and as I go down, this will make a lot more sense. Using $95,000 in the right situation is definitely a wise use, but you'll see why at the end. So, $16.50 a piece times 2 is $3,300. So me throwing $95,000 down financing $385,000 at a sales price of $475,000. That's what she wanted. Now, if she were to sell each unit individually as a half duplex, I think she's a little bit high, but not very. It's pretty close. So that's another good thing, and you'll see that actually with my strategy here in the future. So here we're at 20 years, and yeah, over 240 months at 5.5%. So my payment comes out to be $2613.97. Okay, keep in mind rent is 33, so that leaves me 3,300 minus 2613.97, $686 to play with before taxes and insurance. Okay, so add $800 a month based on that value, give or take. Insurance is more than likely going to be this high because it's a duplex. So I basically showed her, you add all that up. On the conservative side, I'm cash flow negative $200 a month, and it's just like, hey, that's not a smart investment. However, if you want that sales price, I can make it work. And I know that these were trigger points. She didn't want to deal with any of that anymore. I said, hey, there's a 30-year option, 15-year, here. So she's like, I'm kind of interested in more of the short-term to medium-term option. So I said, hey, and we can also structure, keep all your tenants in place, etc., blah, blah, blah. So my prediction, what we've proposed, and we're kind of, this is interesting because this is a current one. This is a back and forth where we have verbal, and she said, I like what you're saying at lunch. Send me the terms. And I'm going to send her a couple routes. One with probably 10% down. Again, probably 5% down. I don't think in that. I'll do like a 0% and a 5%, and then just kind of do it that way. And then she may say, well, I want more money down than that. And I'll say, I mean, I can. Again, it's an open whiteboard. But this is the structure. My goal is to amortize. And she said she'd like to be out in like 5 to 7 years. So there's a little bit more of a kink in things. But let's go back to our handy dandy thing, which I use these all the time. But if I finance, let's just say, it doesn't really matter, $125,000. So my goal is in 7 years. So I need to cash flow positive on a monthly basis, and each unit $500. So I want to cash flow $1,000 a month. So how do I do this? Again, I sat down on, okay, how do I cash flow $1,000 a month? On this unit, how do I cash flow $1,000 a month? How do I set myself up with at least $100,000 equity at the end of the term? And so what's interesting too, like this has kind of been the goal, is like, hey, I'm looking at $100,000, but maybe I can start structuring things. Okay, I want this equity in the future. And so you can see maybe it won't make as much sense for me to cash flow there, but I got kids, I got bills, I like to cash flow. So how are we going to do this? So going back over here, she wanted 5 to 7 years, year term. If I can work backwards from 475 minus, if I get $125,000 equity, that's what I want, equity end of term. Now, we're going to do this all on 0 down. If she wants some down, that's fine. But again, my ideally is 0% down because she's wanting an astronomical price. Hey, I'm going to pay you $100,000 over what this estimate is. Even though I'm with her, I think it's probably worth pretty comfortably $450,000 if you parcel out each unit as a half duplex itself. That's my exit strategy into the future. But the goal is to create this equity and then cash flow the whole time, right? So target is to get to $350,000 payoff. All right. So $125,000, probably going to have to pay some interest. 7 years. What did I just do? I jumped it back $1,000 a month from 20, remember, $26.16 was my payment at 5.5%. And again, I did lower interest, but that's the bargaining table. It's like, hey, you got to give and take, compromise. And again, it's building trust, making sure that person trusts you and likes you is literally 90% of the battle, because they got to do business with somebody they're going to trust their word. But 7 years here, $1,650 would be what I pay her per month, and then it's on a loan of $125,000. So okay, I have a proposal. 7-year term. There, that's what I want. So I have a balloon of, and I know she's going to take the offer. We're just going to have to wiggle down the down payment situation. But balloon of $350,000. Monthly payment for 84 months is $1,650,166. Okay. So, what were those taxes and insurance? We're gonna do the high side. $225 and $800 is $1,025 a month. PITI, payment, insurance, taxes, interest. That will be 1651.66 plus 1,025 a month is what we had. Okay. And again, I'm just putting this on there because people are gonna have to go back to it. If you're listening, thank you for bearing. 1651.66 plus 1,025. That puts our payment at 2,676.66. 2,676.66. Alrighty. So that's my all-in payment. Now, how does that look for a cash flow perspective? So, as is, remember, the rent is low, and I know that for a fact. But my goal is to keep them in place, and I will work with them, and I will gradually work the rent up, but within reason. I'm not going to be a jerk like some of these people trying to cripple the Californian economy and etc. So $3,300 minus PITI is 2,676.66. Gives us our net cash flow. $3,300 minus 2676.66. $623.33 a month, as is right now. 623.34. 623.34. Okay. Now again, how do I improve from here? And what are the strengths and how to improve? Well, when this in 7 years, I will 100% own a property that more than likely, if let's factor in 450,000 1.02, and this is 7 years of inflation. So times 1.02 times 1.02 times 1.02 times 1.02 times 1.02 times 1.02. 516. So whatever. We'll go off that. Future projected value. We'll just say 500,000, which is low. $250,000 per unit, which is very realistic. Because right now, I mean, that's not attainable. But honestly, I think if they were Chip and Joanna it out, they'd have a shot. Okay, so after 7 years, I'll owe $350,000. Okay, well, again, my goal was $100,000 in equity. That's therefore $150,000 equity. Alrighty, and if it went out, $623 cash flow per month. Now, cash flow. 623.34 times 84 months equals $52,360 in 7 years. So divided by 7, $7,480 a year. Again, conservatively with the tenants, if I increase rent, let's just say in theory I was able to increase it $700 a month, which I think is very aggressive and probably not going to happen. But let's just say 400. You know what I mean? It's almost doubling that. I mean, that would be more like, what, 80 grand? I mean, we could do the math, but so 52,000. Well, that's not even gross. That's net profit before repairs. So, or a property manager, but my property manager is very cheap. Alrighty, so I turned this deal into 7 years into over $200,000. Over $200,000. And then I mean, this might sound too good to be true, but about almost 12 months ago now at this point, I devoted to like learn how to do this because I knew of a group of investors that were learning how to do this stuff. And I was like, why the heck would I not figure out how to do that? That makes so much sense, and it's a way to truly get a ton of money. So again, exit strategy in the future, I can either refinance that and keep renting it out, or maybe she even will want to carry another note and I can give her a lump sum, another down payment. There's just a lot of crap that you can do with it on the backside. But again, if I can sell it for $500,250 a unit, and I owe $350, that's $150,000 before closing costs, and then I've made this the whole way. And then between these two properties, that's $1,000 a month cash flow per month. So that's really it. I'm going to cut it short. I'm sure that blew a lot of people's minds, and I hope so, because that's the goal. And I can help you structure these things. And I mean, obviously, I'll definitely make it worth my while in terms of assignment fees and whatnot. But if it's, hey, you don't have to go out and negotiate these, because I'll be firsthand, these are extremely difficult to negotiate. And fortunately, being in real estate for quite a while, having a brokerage, having a big team, that helps provide a lot of credibility. But again, I really encourage everybody to get involved. If you have equity positions and you're sitting on your hands and not taking action, in the wise words of Mr. T, I pity the fool, because you're doing yourself an injustice. There's a lot of opportunities out there, and there's even more becoming available. In terms of marketing Summit Coast specifically, we have leads coming in galore. The agents, not all of them, but some of them are doing some stuff that is creating a lot of fruit. It's awesome. And then me personally, I send out, let's see, 8,000 pieces of mail a month. And then we direct contact them too and call them. And my full-time leads manager is putting probably anywhere from 2 to 5 conservatively leads a day, whether that's today or in the future, into our thing. So if you guys want investment deals, just tell me what you're looking for, what you want to do, how much you got to play with, and we'll make it happen. So reach out to me. I'm extremely busy, but I will make time for everyone. I always do. But get in touch. Email or text is the best way, and I would love to help you guys make some cash in real estate investing. So I appreciate everybody watching. Let me know what questions you have, and talk to you later. Let me figure out how to get off this thing.